Good morning and welcome to our interim results presentation. We'll talk a little bit about Eagle Eye by way of background, then take you through the highlights of the half. Lucy will review the financials, and then we'll talk a bit about the future and the strategy, and then take questions at the end. There is a personalised marketing revolution going on because it is the most cost-effective way of doing marketing. If I can get you the message you want, the offer you want, an offer that is on something that you like, that is much more likely to promote action, to promote your loyalty, than sending you generic offers, and it's much more cost effective. So that, I think, is understood. What is unlocking it is technology like Eagle Eyes, which, because of the scale outlined on that slide, enables it to happen, enables personalization to take place. And with the advent of artificial intelligence, this greater realization from businesses that they are able to get more and more precise analytics, and that there's a race on to do that, and they need to be part of it. So very large volumes, many people using the platform, and a great list of clients been able to piece together over the years. So let's talk a bit about the opportunity. The market, for the reasons that I've described, is growing, and I think that AI is just driving it further forward, and that businesses that are not hard discounters are having to use data in order to build relationships with consumers to defend themselves against hard discount competition. The consumer is increasingly used to personalized messages, with Spotify, with Netflix, with Instagram, with all these things that they do and use every day. They are more and more used to being treated as an individual with their tastes being reflected, and they expect that from businesses. What we do is we enable businesses to do that, and in effect to follow the golden rule of treating their customers like they would like to be treated. We're a technology company, but in my case, we're run by a retailer, and we have quite a lot of ex-retailers in the business who really understand the business of our clients, and we enable them to do their marketing in a better, simpler, and cheaper way. And finally, the technology is of the moment. Air is delivering what retailers need, which is real-time offers and communication in the modern way. So being API-based, composable, cloud-native, all those things that you're looking for to build a contemporary stack. And it all runs on Google. So I think if you take all of that together, there's strong drivers for the growth of the business. We had a positive half one. We grew particularly internationally. Our ARR is ahead of our sales growth, and we continue to deliver the Rule of 40. We had a capital markets day a few weeks ago where we outlined our medium-term ambition to have revenues of 100 million and an EBITDA of at least 25%. Critical to that, we believe, is being the best company to work for. We think that the best company to work for is the best company to work with. And so we spend a huge amount of time and effort investing in our people, investing in what we call the Purple Way, whether that's training, behaviors, values, career development, all of those things, because people stay for longer, they're more productive, they believe in the business more strongly, they're better for the customer to deal with, hence our level of NRR and also our retention. So whilst we believe it's the right thing to do, we think it translates into strong business dynamics. Our acquisition of Untie Knots about 18 months ago now has spawned the development of Eagle AI, which is a new data science offering. So not only can we enable you to transact your personalised offers. We can also help you to create those offers and then transact them in a seamless end-to-end process. The first customers have been secured for Eagle AI and helping us to grow the pipeline strongly. Our strategy is to win new customers, get them transacting on the platform and deepening, and we've made some good progress on that in the year, to then innovate on the platform so that we've got new products, new capabilities, which help us in the win process, but also help us in the deepening process. We continue to be fixated on £1 of win in year one, becoming £3 by year three. We then take that to new geographies, and we'll talk about the development around the world and how we're getting more sure-footed in more places. We run the business in a better, simpler, cheaper way, generating an EBITDA in the 20s. And we have the opportunity, we think, with what we've learned from Untie Knots, to potentially do complementary acquisitions if we find things that are truly complementary and can be done at the right price. So the organic plan will get us to 125, we believe, but it's possible that M&A can get us there faster. And the whole thing is underpinned by these purple people. I'll hand over to Lucy, who'll take you through the numbers.
Thank you, Tim. So as Tim said, we've had a strong first half, and you can see that in the KPIs on this slide. And overall, we've delivered the Rule of 40. I'll talk about what that means as we go through the finance presentation. So starting with the top line, we've achieved growth of 20%, and we've done that by both delivering on our customer strategy and also the contribution of Untie Knots that joined the group in January 23. So starting with the customer strategy, we've had some nice new logos join the group. Paston Food Group, a retailer on the west coast of Canada. They've taken a collection of products from us, but actually was the first customer that signed with Eagle AI. We've added a new pet supply company, which is a significant brand in North America. We've added the Ivy for employee discounts and a new retailer in Australia that represents a business in a slightly different sector to traditional grocery. Our volumes have grown significantly by 65%, and the big contributors to that are Asda, Woolworths, and the big US client. And we see that from a revenue perspective of transaction growth of over 20%. Following on with Deepen, both Asda and Woolworths contributing to that and really helping driving that NRR rate of 120% in the period. Morrison's added challenges, and Tim will talk about that as a use case later on in the presentation. And then post-period end, both E.Leclerc and Auchan customers of Untie Knots, they've renewed with them. But interestingly, one has had a step up in their revenue, and the other one has gone from campaign activity to always on. So we've got more surety of revenue and moving to a more similar model to Eagle Eye in terms of the shape of contracts. So that's good step forward on both of those. I think the last point just to note on this slide, we've been impacted this period by SMS fees going down by 12%. We saw at the back end of the half, our biggest client for SMS, the volume significantly reducing. We expect that to continue into the second half, and by the year end, SMS, which is not a strategic part of the business as I've talked to you before about, to be pretty much de minimis. So moving on to the income statement and following on from that point, those of you who've understood the story for a while, the gross margin is impacted by the SMS, which has a much lower gross margin than the air business. So the impact of the sales has ticked up in terms of percentage points, the gross margin to 96%, and we'll continue to see that benefit for the full year and the next year ahead. Our operating expenses have grown by 22%, so in line with the gross profit growth. The key contributors to that increase primarily have been staff costs, and that's an area that we've continued to invest in terms of the operational activity of the business, where we're now having to support from the UK to New Zealand and making sure we can deal with customers in real time levels from a first and second line support. So we'll begin to see operational leverage from that in future periods. Also, our delivery resource has gone up in line with the top line. And then also, of course, on top of that is the cost of untied knots that came in from January. So there was no impact in terms of the comparative period. That represents 1.4 million of the 10.6. Our infrastructure costs have grown, but by 10%. So compared to that significant growth in volumes going through the platform, that's quite a modest growth in terms of the cost base. The product we continue to invest in, and I'll come back to that in a slide's time. And overall, that presents an EBITDA margin of 24%. And in the period, Eagle Eye has overperformed compared to that because we're still carrying a lower margin from untied knots, given its size. And as it gets bigger and its growth happens on the top line, we'll see that move more towards the established Eagle Eye margin model. Looking down at the bottom line, the adjusted EPS has grown by 20%, so continued growth both on the top line and the bottom line. So coming back to the product, it is an area that we continue to invest in. It's very important for both existing customers and new prospects. You can see the volumes on the right-hand side here. So compared to this time last year, the number of API calls has grown by 23%. And the platform is driving over 8 billion of API request calls in 1 month. So therefore, it's essential that we continue to invest in the health of the platform, which we call these 5 S's on the left-hand side. And we'll continue to do that. One of the interesting things about being a cloud-based business is we now have access to cloud-based other tools and technologies. And actually in this period, we've started to spend some time in line with our strategy of being a much bigger business, of tools and technologies that can not just nudge us forward, but can make significant improvements in terms of the ability to drive more volumes at higher speeds as we come that journey towards the 100 million. So more on that I would expect to come in future periods. We've continued to invest also on functionality. We've added new functionality to our cloud-based adjudication service. Now that's the rules that basically govern the technology within AIR that dictate what rules we can apply. So we've added more rules, more sophistication, but at the same time, we've improved the speed of which the technology can speak to the till, and therefore our response times can improve. We've added new capabilities as social and behavioural actions. I talked about those about 6 months ago, but Tim will elaborate more on those as we go through the presentation. And we signed a new partnership in January with a company called Commerce Tools, which provides technology to e-commerce businesses. And now we've done an API link. So customers of Commerce Tools, if they want to use loyalty and promotion technology, they can do that incredibly quickly with our already linked-in APIs. So moving on to cash, I think 2 sort of key areas to talk about in the period. We've gone from having an inflow in half 1 23 to an outflow in half 1 24. So I wanted time just to explain that. So the first key impact has been the bonus. So the good performance in FY23 resulted in an increased bonus payment of 1.4 million, both bonus and commission in the period. And then in addition to that, we had a cash-based incentive from Google Cloud as part of our package that gave us a cash benefit last year of 0.7. So that was a one-off. And as a result of us being more profitable now, in some jurisdictions, we have to pay tax, and that increase accounts for 0.6 million. So a lot of those things are just a seasonal event. And so therefore, in the second half, we're expecting to be cash generative, and overall for the year, cash generative. So it leaves us in a strong position at half end of 7.8 million of net cash, and our facility with HSBC in place, and the accordion, which at the moment we're looking at renewing, both with options with HSBC and other banks to get a competitive rate. So more on that, I'm sure, next time I see you. So I thought it was worth just finalising sort of my section by just recapping on the strong organic revenue story. We've got a high growth subscription model which represents the license and transaction fees of 78% in the period. We've got a really nice model that we've talked to you about before, that when we get it right, £1 of win translates to £3 of transact and deepen. And what we've seen in the period, that's driven the really strong NRR number of 120%. We've got very low levels of churn. We sit right in the heart of customers' architecture, and we benefit, therefore, from very nice low levels of churn. It was 1.2% in the period. And then the analysis here illustrates that actually from a top 20 customers, there's a lot more to go for in terms of opportunities to upsell to our existing customer base. And with the advent of adding new technologies in, such as Eagle AI, that just gives us even more opportunity to drive accounts and continue the growth that you see on the left-hand side here. So that's that from me, and I'm going to hand over back to Tim to talk to us and recap on the strategy.
I'm going to talk to you about 4 things. An example of our customer strategy, how the innovation around Eagle AI, progress, and what's next for our people, which I've already outlined the importance of. So starting with the Morrisons case study. So in June 23, we won the contract to handle the Morrisons More Card loyalty program. And that went live by October 23, so much quicker than historically would have happened. And by April 24, we were the points ledger and the loyalty ledger managing 5 million customers. And then by January 24, they had decided to buy the next product from us, which is the Eagle AI anti-knots product, the challenges, as a way of their customers earning more, to coin a phrase, loyalty points. And that has got off to an extremely good start. So you can see how quickly we're now able to move a client from a win through to being transacting on the platform and then deepening with other products and services that we offer. So Eagle AI was spawned from challenges, the product on the left and the clients on the left. So we bought this business that was using AI to generate challenges for Carrefour, Auchan, Leclerc, etc. And we were extremely impressed by how well they'd done in the French market. We bought them, and as we started working with them, we realized that this AI capability and the algorithms that they had would actually be just as capable of picking a promotion as they are of picking a challenge. And so we built the capability for them to build money off promotions, meal deal promotions, points-based promotions, to extend the capability of the AI around the promotion set. That's so far been bought by Media Performance, who are a French media business, rather like Neptune, where we have the relationship in the US, and their job is to source promotions for redemption in Carrefour. So we're using it for them. And we sold Eagle AI as part of the package for the Patterson Food Group that Lucy mentioned, which trades principally as Save On Foods. So we're off and running. It opens up for us a significant new addressable market, which this chart is predicting a significant increase in the use of data and data analytics, frankly driven by AI. So new addressable market, which looks as though it's going to grow very fast. The core addressable market of transactions, Eagle Eye, is already growing fast and already benefiting from the advent of AI. How do we take this forward? Well, the first thing we try and do is we try and cross-sell it into our existing customer base. The second thing we try and do is we try and sell it to possibly smaller businesses. The really large enterprises tend to have made an investment of their own in the area of data analytics and therefore don't want a third-party vendor. But Patterson Food was an example of that. And then to roll this capability out to the rest of the world. And we'll continue then to develop the product going forward. So as Lucy mentioned earlier on, the ability for the Eagle Eye Air platform to execute social and behavioral actions, in other words, to recognize behaviors other than simply the purchasing of a product, creates the opportunity for AI to be targeting those sorts of activities in a new and different way, giving the retailer a more comprehensive set of tools with which to personalize and communicate to their customers. Every year, we've become a little bit more capable around the world. The US has grown strongly. The UK and Europe is a bit below where we would like it to be. In APAC, we've had very strong growth because of new wins and because of the deepening effect with Woolworths. We've got relatively recently invested in people in Asia, Germany, and France, and those people with Asia leading are starting to gain traction and get us involved in more conversations, which is why we're able to report that the pipeline is 2.5 times bigger than it was the last time we spoke to you. And also, about 30% of that growth is driven by opportunities for Eagle AI and challenges. I've already made this point about the best company to work for is the best company to work with. We were 7th best company to work for in the UK last year, and we've set the objective of trying to be the best company to work for. We track our NPS every quarter, and those net promoter scores for whether you would recommend it as a place to work and how much you would recommend the product are extremely high. Our next phase is to introduce more and new training, a combination of technical skills and life skills to enable people to do more, but also to feel better about themselves and how they do it. We're going to invert the pyramid, as I describe it, which is basically we've done an awful lot for our people by working very hard at the top of the business and then cascading it through the organization. We're now going to go to those people and say, how do we make this company a better company to work for? And we're going to create a new employee recognition program. As I indicated before, what we're also starting to do is to track the business case for this. And you can see in terms of attrition and tenure, productivity, savings on recruitment, and most importantly, customer retention. These are all very accretive measures in terms of the value of the business that we run. So we think we're in good shape to deliver 100 million of revenue and 25% of EBITDA. We've got great people. We've got a great platform which we keep investing in. We keep innovating around the product, the core Eagle Eye Air product, but obviously this great new innovation in terms of AI, and created this connected capability to win people the data through running loyalty schemes, to analyze that data through Eagle AI, and then to create them a personalized promotion program across the complete suite of the promotional mix. That's a lot of new product. And finally, all of that is bolstered by the case studies that we get around the world as we win. So we're confident, we feel we're in good shape, and we can deliver a year of profitable growth in line with the board's expectations.